There are so many companies in India. How do you pick what is the good stock?
The moment I saw this product in the Kirana shop, I went behind, saw the name of the manufacturer, and all you had to do was buy the stock.
I think you have skills in economics, psychology, management, stock market. I bet the role really pays you well.
Investment is all about your comfort. It is not identifying all the exotic names. You need to have your zone of comfort for investing.
In the long run, it hasn't shied away from meeting the benchmark return. Why is that so, Sanjay?
We are going to take risk.
If I'm a new investor, does this merger concern me in any way? Hi, thank you so much. Sanjay, thank you so much for letting us do here. This is the Know Your Fund Manager series where we want to bring out the style of the fund manager, but since we are here, we also want to talk about markets, different styles of investing, etc. Thanks for letting us do this series in your home. It's a beautiful house. I see wonderful paintings everywhere. So how long have you been here?
So thank you so much for coming down. It's a pleasure to host you at my place, and it's a nice setup that you have. I've been staying in this house for the past 15 years now.
Lovely, lovely. So you've been a Mumbaiker?
I have been a Mumbaiker all my life.
Okay, okay. So who all live in this house?
So my daughter and I live alone out here.
Okay, okay. So let me take the role of your daughter's friend and ask questions from a non-finance background about markets, investing, etc. So I hope you'll be, simplifying as much as you can.
Absolutely. I'm looking forward to this discussion.
Thank you so much once again.
Thank you.
Sanjay, thank you so much for letting us do this in your home. That's really special to us. We really appreciate it. Let me take the role of your 25-year-old daughter's friend who wants to know about markets, the style of investing, etc. So here I wanted to ask, what do you do, Sanjay?
So thank you so much for having me on this show. It's really a pleasure to have you at my home. It's very nice and sweet of you to come and do the interview at my convenience. I'm the Chief Investment Officer at a mutual fund. So the question is, my role as a Chief Investment Officer, that is the CIO, I take care of the investment decisions at the mutual fund. A mutual fund is nothing but a pool of money given by different investors who invest in a bunch of stocks. The reason why an investor would give a money to a mutual fund could be varied reason. It could be because they don't have time to invest, maybe they don't have the knowledge to invest. And the beauty of a mutual fund at this stage would be that they may be able to own an entire portfolio of different companies, diversify their risk. And the way I look at it is, our objective in a mutual fund is to generate an optimum risk-adjusted return.
I think a lot of jargons here, so I want to understand each one bit by bit. But tell me, Sanjay, what did you do to get into this fund management industry for you?
From a very early age, and you'll be surprised, and let me get you into a secret. I was interested in the stock market right from the time when I was in the 9th grade. And, over the last 40 years, the equity market has evolved very significantly. Evolved in terms of the depth, evolved in terms of the breadth of the market, evolved in terms of the professionalism which has come throughout there. And very interestingly, at that time, I had no knowledge of what I wanted to be in the stock market, except the fact that I needed to be in the stock market. Coming from a family of engineers, the natural choice for me was to do engineering out there. Once I did my engineering, I realized that I needed to get a better understanding of the businesses. So I did my management degree. And in between the two, I had actually squeezed in some courses in economics as well as in psychology. At that time, I had no concept or view of what I wanted to be in the stock market. And it was sheer curiosity and interest that I ended up doing all these subjects. Interestingly, After I graduated, I joined as a management consultant, and very soon I realized that, hey, my calling was in the stock market. I actually became a research analyst, and since that time, I've seen the market change over a period of time.
I think you have like skills in economics, psychology, management, stock market. I bet the role really pays you well.
So it's a very interesting role. Besides the money in the role, and I think there's money in all fields. It's not just that the investment field has money. As long as you're good in the field that you're working in and you excel, you should make money out there. What is very exciting in this field is it's a very dynamic industry. Dynamic, and there's never a dull moment. You're always learning something in this business. You're learning about new businesses, you're learning about technology changes, how it's impacting the various industries, how it is impacting the various companies. You're always on the roll. You're watching how the company managements are evolving and ensuring that the volatility in the business is the least. Typically, what we really focus on most of the time is on the businesses and not really on the stock price per se. Stock price is always an outcome of the business.
So you invest in stocks in the stock market, but we often hear, I mean, for someone from the non-finance background, we often hear that stock markets are very risky. They go up suddenly and they fall suddenly. So do you get overwhelmed, or because you're managing a lot of people's money, right? Do you get scared if market falls?
So very interesting question, Satya. And I have been in the market for a very long period of time, and there are a few lessons that I have learned. The lesson number one is you don't lose money when the market panics. You lose money when you panic. And that's a very important distinction that you need to have. In the last 34 years of my life, I've seen multiple cycles in the market. Some of these cycles have been very deep in terms of the bear market cycles. In fact, in the early 90s, I'd seen more bear markets than the bull markets. And therefore, I keep saying that I'm a child of the bear market. So that's something that I've witnessed over a period of time. But having seen so many cycles, there are few things that we've learned over a period of time, and we've tried to imbibe in the way we go about investing. Some of the key learnings that we've had over this period of time is and it's very important to distinguish between the different types of bear markets that we have. So let me classify the bear markets into broad two classifications so that we have a better understanding of the same. The bear markets can be classified based on the sector impact or a broad impact on the market. Let me give you an example of both of them. During the year 2000, when the entire world was panicking, when they were moving to because of the change in the century, there was a tremendous opportunity for the IT companies, and people believed that this opportunity would continue for a very long period of time. There was a lot of exuberance in the market. The stock price went very high, and it was assumed that this opportunity would continue for a very long period of time. However, post the year 2000, the entire TMT sector, that is IT sector, telecom sector, and the media sector, came off very significantly.
Is that the dot-com bubble?
That is the dot-com bubble. That's right. That's right. So that was a sector-specific bear market out there, which really did not impact the overall market. The other bear markets are more generalized. It could be because of, if you remember, during the Asian financial crisis, in the Asian market, because of the currency impact, most of the markets in Asia fell down significantly, including India. So which was confined to a particular region because of a run on the currency of the country, which was there specifically in Asia. On a broader level, we had seen the global financial crisis where the world market fell very significantly. And more recently, we had a natural pandemic where globally all the markets came off. So there are various nuances, there are various types of bear market. Having said that, I would say that all these bear markets have certain common features running through all of them. And we've tried to identify all these features and try to inculcate them into our investment philosophy. The biggest thing that we see in a bear market is there's a flight of capital towards safety.
What does that mean?
Safety would mean that you're looking at stocks which are less volatile. We are looking at stocks which are less leveraged in the sense that they don't have to borrow money to run their own business and to continue to grow. Typically, in a bear market, the primary market or the ability to raise money from the market goes down. So you start looking at companies or businesses which are self-funding, which do not require any external help to grow their businesses. You need to see companies which are frugal in their investments. And those are the companies which tend to do well. Then you need to see how efficiently is the company making capital allocation decision, which will ensure that the company continues to grow out there. For example, let me give you some example of some of these sectors. Sectors like pharmaceutical, sectors like FMCG or staples, sectors like IT would actually classically tick mark all these factors, all these things which tend to do very well in a bear market.
So now you're saying that you are a fund manager who are looking at stocks in the market and investing in them, right? So like, how do you pick stocks? Like, what are good stocks? Maybe there could be some good stocks, bad stocks. I'm sure there are so many companies in India. How do you pick what is the good stock? How do you know that?
So that's a very interesting question. And, I'm going to take it a little more broadly. On the Bombay Stock Exchange, you have more than 4,000 companies listed, which have been classified into large cap, mid cap, and small cap. The top 100 market capitalization companies are the large cap. The subsequent 150 companies are classified as mid cap. And then you have the small cap and then the micro cap. As a mutual fund investor, we look at companies which are large cap, mid cap, and small cap, which would mean that the total addressable investment universe is over 1,000 companies.
So how do you go about picking these stocks?
So once we've decided that, look, we need to be in the large cap, mid cap, and the small cap, we have an investment framework by which we decide on what are the companies that we should be looking at. There are 3 pillars of investment framework that we have decided, which is called business, which we call the BMV framework, which stands for business, management, and valuation. We would like to have businesses which have a moat in the business. Why do we need moat in a business? We need a moat in the business so that there can be longevity in terms of the earnings, sustainability of the earnings, and the predictability of the earnings.
Moat is the USP of any company.
Absolutely. Moat is what will ensure that the business continues for a long period of time. There could be various moats. For example, if somebody has a technology which nobody can copy, that's a moat. A company which has a brand, that is a moat of a company. The company may have access to raw material which nobody else has. That is a moat. It could be a moat could be because of the license that the company has.
Coke's secret formula.
Absolutely. So Coke is a classical example where they have a moat in terms of what is the secret ingredients which sustains them for a longer period of time. I'm sure many people have tried to copy that, but they've not been successful. They've been close, but not as good. So it's very important to see the moat of a company, and once you have a moat, then you have certain characteristics of the company. The characteristics that we really look forward to are A, how visible are the earnings, how sustainable are they, how predictable are they. Our typical time horizon is about 3 to 5 years, and we would like to see the earnings visibility for that time period. The second pillar of investment is, of course, the management. Now, typically when we talk about management, people actually talk a lot more on the corporate governance side.
What is that?
Corporate governance is how well do they treat the minority shareholders? Are they being fair to all the stakeholders? And when we are talking about stakeholders, we are not only talking about the shareholders, we are talking about how do they treat the employees, how they treat the distributors, because the moment you have somebody who's fair all across, then they will be fair to you as an investor. So that's what we really look at when we are talking about corporate
How
governance.
does that matter for a growth in a company or growth in the return from the stock?
Typically, when you say that if the corporate governance is good, then whatever the growth in the company that you see or whatever returns that you see, the management will be able to share the same with the minority shareholders.
Which are the us?
Which
Who
are non-promoter shareholders, whether they are institutional investors or retail investors, we would all classify them as minority shareholders. The challenge in most of the management is the management in India specifically are promoter driven. And hence, it's important to study the management.
You mean it's mostly family-owned businesses?
Family-owned businesses who are also a part of the management, who take decision. Unlike some of the companies in the overseas market, where the ownership of the company is separated from the management. In India, there's a significant overlap between the ownership of the company and the management of the company.
And that distinction is important?
It is important because their goals and the objectives have to be aligned to the same thing. So as long as you're treating all shareholders equitably, including the promoters, then you would act in a certain manner. And I think that is very important to be careful of. So that is the corporate governance part. However, I started off by saying that there are about 1,000 companies which can potentially be in our investment universe. We have a smaller sub-segment of that. We have close to about 500 odd companies in our investment universe. So there are two criteria to get them into our investment universe. One is the minimum market capitalization criteria, and the other is based on certain investment thesis and management qualities that we look at. So when we are evaluating the management, we are looking at the competencies of the management. Competencies in terms of how well do they manage the business, because if it's a steady state business, you really don't need somebody who can, you need a rocket science to really address it. We need to see how does the management behave during adverse circumstances. How well are they managed? How well are they able to manage the volatility in the business? The case in point being, how did the management behave and manage the businesses during the COVID time? It was applicable for everybody, but different companies different management behave differently. And that actually tells us when things go wrong, how do they manage the business and ensure that there's a smooth running of the business out there?
Can you give some example on how different managements reacted differently to COVID?
So, for example, in case of the biggest thing in terms of COVID was there was a complete disruption in the supply chain, whether it was in terms of raw material or in terms of the delivery of the goods and the services. Some of the companies were able to surpass that, overcome these challenges. Some of them went digital. Some of them came up with new business models for delivery and ensured the sustenance of that business. And that is something very interesting that led to us to believe that we need to separate most of the management from what will just survive and some management which will ensure that the business grows. So if you have an average management with a good business, it's going to deliver average performance. But if you have a good management with a good business, that's a winning combination that we have. And finally, the third leg of investment is the valuation. I think that's the most critical determinant of the stock returns that we have.
What is it?
So when we are looking at valuation, there are multiple ways of looking and evaluating a company. What is the price that I'm paying for that company? And what is the fair value that we are getting into that? fair value can be determined by various means. There's a classical science behind how do you calculate the fair value of the company, what is the intrinsic worth of the company, and market price tends to fluctuate up and down. Ideally, we would like to buy businesses or companies which are at a discount to the fair price or the fair value of the company, and sell a business or a company or a stock once the market price goes above the fair value.
Can you give an example there?
So, for example, if I believe that a certain company is worth 100 rupees and the stock price is at, say, 80, the chances are that I would buy that company because there's a mispricing by the market in terms of how the market is perceiving the value. So, I need to be confident that this 80 will become 100 plus at some stage, and we've seen that happening over a period of time. The disconnect has always been between the market perception in terms of the value. Market moves in cycle. During the bear phase, the market tends to misprice the underlying asset very badly, and they trade at a lower price. During the boom, the market tends to look at it differently in a completely positive lens. So we need to balance out the emotional aspect of the market investing. Balance it out, and you can do that only if you understand what is the fair value. Your ability to calculate the fair value will determine how you perform.
Oh, so your role in your company is to see what is the fair value of the company, and then see if there is any discount, then you will invest, otherwise you will sell.
So that's a very simplistic way of looking at it. Yes, you're right. That is the very basic tenet of investing, to assess the fair value. But what goes behind calculating the fair value is a very important thing. You need to look at the world market, you need to look at the world economy, you need to see the long-term trends, change in the technology, how is it impacting the business models of the various sectors. You need to see how has there been any change in the supply chain which is actually happening, and what are the companies doing themselves to adapt to these changes, and then you arrive at what is a fair value out there.
So you work for Baroda BNP Paribas, right? So is this something related to Bank of Baroda?
Oh, that's a very interesting thing. Yes, it's a joint venture. The Baroda BNP Paribas Asset Management Company, or Baroda BNP Paribas Mutual Fund, is a joint venture between Bank of Baroda and BNP Paribas Asset Management Company in Paris.
Oh, okay.
So Bank of Baroda is the second largest PSU bank in the country. It's been around for more than 100 years. BNP Paribas is the second largest AMC in Europe and probably the 8th largest AMC in the world.
AMC is this asset management company.
That's right. So what is colloquially called the mutual fund. So AMCs are the one who manage the mutual fund.
Okay. How is your office? How are your colleagues? Everyone have the same interest and the same skills that you have?
Investment business is a very tough business. It sounds very simplistic on the surface. We have a large team of pool of analysts and fund managers who manage various sectors. We have a team of sector specialists, analysts who track all the sectors within that and the companies which fall under that. We have a bunch of fund managers who manage different strategies out there. Education wise, we have a lot of diversity in terms of people who've done their MBA, people who've done the chartered accountancy. They have done CFA out there. Some of them are financial planners. The beauty of all the team members is we have a lot of experience and seen a lot of cycles out there. So even my analysts would have seen at least one cycle in the market.
And cycle in the sense?
So cycle is a boom and a bust. So the way you value a company during a boom time, the way you behave is different. And you will be able to manage that volatility only if you have experienced that and seen that cycle. And I believe that our team, which has seen multiple cycles, depending upon the fund manager or the analyst, are well entrenched and to identify how to behave in the markets when things go wrong.
Got it. So whatever product you see, you you flip the product and see who manufactured it.
So
because you are in the stock market.
So that's a very interesting question, and I thought I'll just share with you a very interesting thing which I had in my investing career. This goes back in late 90s. This is the time, and you gave the example of Coca-Cola.
Yeah.
Right? So Coca-Cola came back into the country after Pepsi was already there, and the only way they could come back and get the shelf space was by paying something to the distributors. When you go to these typical Kirana stores, the biggest challenge was they had a limited shelf space and they had all stock Pepsi. So what did Coke do? They went ahead and spoke to one of the refrigerator manufacturers and they came up with these see-through refrigerators, which is quite common right now, where you have a glass panel and you can see the content out there.
Yes.
And we realized that was a brilliant strategy, because what Coke did is they tied up with the manufacturer
of the
refrigerator, and they said that if you buy so many crates, this refrigerator is free for you, but you need to stock our product. Very interestingly, we calculated the number of Kirana stores in the country. What was the total demand? It was a multi-year story for investment for that refrigerator manufacturers, and it did extremely well.
Wow.
All I had to do was, the moment I saw this product in the Kirana shop, I went behind, saw the name of the manufacturer, and all you had to do was buy the stock. So you're right. So
I'll also be on the lookout for companies and the brands that they are coming up with now.
So that's what I say. Investment is all about your comfort. It is not identifying all the exotic names. You need to have your zone of comfort for investing so that you can identify the risk. And I think that's very important to understand. So if you understand a business, then you understand and you're able to assess the risk better. And in investment world, it is all about risk-adjusted return.
So risk is what can go wrong.
Risk is what can go wrong. It can be volatile. You can be what we call a whipsaw out of the market. The stock price may behave in a certain manner because of certain perception. The reality may be something else. As long as you know what is the reality and you can ignore the noise of the stock price movement. And that is what I say, you need to invest in your zone of comfort. So if you understand something, I think that's the best place to invest.
Got it. You mentioned risk-adjusted return twice. What is risk-adjusted return?
So typically, depending upon the investor's appetite of risk, you need to look at investments. For example, as an investor, investing in a small cap is a lot more riskier than investing in a large cap.
Yes.
Because the volatility is very high in small caps as compared to large cap. So you need to have an optimum portfolio of large, mid and small cap so that the returns, your return expectation is well met. If I'm taking undue risk, the question that I should be asking is, am I getting adequately compensated for the return that I'm getting? For every unit of risk that I'm taking, I should be more than compensated in the return. Otherwise, just taking a risk in a particular portfolio or a particular company is not really worthwhile.
Can we calculate risk? Is there any number?
So there are certain formulas which are there, certain things which we look at, which the risk team does very effectively. Some of the names are like standard deviation, which measures the volatility of the return compared to the means. Then there are certain more other exotic tools like Sharpe ratio, Taylor ratio, etc., which require a lot more complex ways of calculating. But from a retail investor, from a knowledge perspective, all these ratios are calculated and published in a fact sheet. So investors need not really look at calculating these numbers, I think it's very important to understand and ask questions before you invest in a mutual fund. Okay, what is the standard deviation? What are the Sharpe ratios? How is it benchmarked against the underlying index? Are you outperforming, or how volatile is this performance?
How much risk do you take when you invest in stocks?
I think it's a function of what is the underlying portfolio. If I was running a small cap, the risk is obviously going to be higher than that of a large cap portfolio. As a fund house, we've defined what is the level of risk that we will allow each of the fund managers to take compared to the underlying benchmark, which would mean that we've set certain guardrails for the sector deviation and for a stock deviation from the underlying benchmark. So the question is, what is a benchmark? Benchmark is nothing but a bunch of stocks which would represent the underlying asset. So for example, if I want to look at how is the mid-cap doing, rather than looking at all the mid-cap stocks, I just take a representative sample of them, put them together and measure the performance of that, which can be used as a measurement tool.
As a sample? As
a sample. It will not be the entire thing. It's like when I'm preparing a dish at home, I usually don't taste the entire prepared meal. I just take a small sample and test it out, and it should be fine, right?
Yeah.
So that's exactly what a benchmark is. From the entire pool, it's a small bunch which will be representative of how the other underlying assets are behaving.
Okay.
So from a risk point of view, depending upon what fund strategy we are running, we are going to take risk. So we have a benchmark, we have sector deviation, we have stock deviation. And why are we doing this? And I think it's very important to understand. As a fund house, we want to align our fund returns to the underlying benchmark that we have. Mm-hmm. And at the same time, we want the fund manager to have enough leeway to perform not only to beat the benchmark, but to beat the underlying index and to deliver above average return compared to the peers.
Okay, so if the sample is giving about 10% return, so you aim for 11% or 12% return.
So we would always endeavor to beat the underlying benchmark. It's kind of difficult to say what would be the return potential, but consistency of the return is something that we look at. What we look at in the portfolio is, are we generating the adequate return for the kind of risk that we are taking? We don't want to take undue risk because we understand our investor profile and what is the expectation, depending upon the category of the fund that we have. But yes, as long as the fund is the benchmark is delivering certain return, we hope to beat the benchmark on a consistent basis in all time periods.
So what is consistent here?
So consistent is, we don't want a fund which will do very well in a short period, not do well in the long period, or do well in the long period and not do well in the short period. So we want not only in the 1 year, 2 year, 3 year, 5 year, but consistently do well in all time periods. And as long as you're delivering above average return compared to the peers, we believe eventually will be coming up in the pecking order.
Okay, so your focus is all on giving the consistent returns to the investor.
Absolutely.
So what would that return be?
So it will depend upon the underlying benchmark, and the benchmarks tends to be all over the place. So if I look at the last 43 years of the BSE Sensex, the Sensex has generated a return of about 15 to 16% compounded every year.
So every year I get 15%?
Every year. Over a period of time, if you stayed invested, say 43 years back, and you are right now, you would have got over 15% return out here.
But in the market, we see someone is making about 40%, 50% returns. What is that?
So in the short term, it is definitely possible that you end up making very good returns in a short period of time. I think it's very important that you stay in the market for a period of time to get a consistency in the return. In a shorter period of time, you can end up with plus 40, you may end up with minus 30, minus 15 also. because of the volatility in the market. We just discussed about the global financial crisis during the COVID time period.
Yeah.
The markets may be volatile. So it's very simple to understand. Our ability to predict short term is a lot less than our ability to predict the long term. Can I say where will I be tomorrow or day after, or what is the increment I will get, or what is the new position that I will get? But I know in the next 5 years or 10 years, I will be at a certain level, at a certain position. It's the same with the stock market. It's very difficult to predict the weekly, monthly, or a fortnightly price movement. There are many factors which drive the short-term price movement. Eventually, the fundamentals will catch up with the market, and that is very important to understand. India is an emerging market. Growth is taken for granted. Economic growth is taken for granted. You will have companies growing very well. You will have management who will manage the volatility. Eventually, that's what matters.
What is the growth of ideal Indian company now?
So
you're saying my returns over a long period of time will be equal to what is the growth that we are seeing of the companies now every year?
So in the last 43 years, we've seen the market capitalization improve very significantly. We are close to about, as a stock market, we are close to about 3.5 billion in terms of market capitalization. There is a definite ratio between market capitalization and the net profit of all the corporate listed companies. While that has moved up, but the pace of the stock market return is aligned to the net profit growth. So I would say that the net profit growth that we witnessed in the last 43 years is closer to what the market returns have been delivered. Maybe they've been slightly slower, the markets have delivered slightly better return, but that's the kind of a growth that we have looked at.
Okay, so in the past, even if I have achieved 40%, 50% return over the period of time per annum or for an year, it will be around this 12%, 15%, 12 to 15% range. So that means since it has gone up so much now, in future years, it will be tempered.
Sure. So there are cycles in the market. It's kind of difficult to predict the cycles. In the past, I would say the nominal GDP growth rate, that is your inflation plus GDP growth, has been in the range of 11 to 13%. My sense is the inflation is structurally coming down to 4 to 6%. The GDP growth rate is going to be at 6 to 7%. So that is the expectation that you should be setting for a longer period of time.
Got it.
Depending upon the government policies, depending upon your demographic profile, you may see a shorter period of time where they can deliver above average return, and there are periods when it may underperform. As long as you're running through a larger time horizon of 4-5 years, you will get a consistent return aligned to the earnings growth that we are witnessing.
I've recently heard from someone that Japan did not give any returns from its stock market for a very long period of like 20 years, 30 years. Can that happen in India?
Sure. So what I've learned in the stock market is never to argue on and be prepared for anything. Whether it's actually going to happen in the Indian market, I don't see that happening, at least in my lifespan. If you look at the demographic profile, if you look at the underpenetration, I think we have a very, very long way to go before we reach a matured economy where structural growth is being challenged, where inflation was being mismanaged, which almost led to a stagflation out there in Japan, leading to the market returns being very, very low or virtually negligible out there. I think India being a growth economy, we have a very favorable demographic profile.
Demographic in the sense we have a lot of youth here.
So demographic profile means what is the percentage of the working population compared to what is the percentage of retired people. India is a young country. Our average age is close to about 27 years. We're going to have a large pool of workers coming into the mainstream. even for the next 10 years, the average age would move to about 37. They're the working people. Unlike Japan, where most of the people have retired and they're not really contributing anything to the economic activity. And that is what has led to a slowdown in the Japanese economy. So you need to watch out for what is the structure of the economy which is driving the numbers out there.
So you're a fund manager who is looking at investing in stocks, good companies. So, but there are so many other fund managers, other mutual funds also. They also want to look at the good companies only for generating return. So how is your investment style different from their investment style?
So you're right. There are almost 44 mutual funds in the country, and each fund manager would have an investment style, and it's very important to understand the investment style of either the AMC and the fund manager. Why is it important? Because the style would determine what is the return expectation that the investor can have. Our approach is a very disciplined approach towards investment. The approach is more fundamental on basis. And when we are looking at any company, we look at 3 pillars of investment. We look at businesses, we look at management and valuation.
Yeah, BMV you said.
The BMV principle that we continue to have. So we follow a GARB philosophy when we are evaluating a company for investment. GARB means growth at a reasonable valuation. As an investment house, we love chasing growth if the stock is available at a reasonable valuation. Let me give you an example for this so that we have a better understanding. You have 2 companies, Company A, which is growing at 25% but trading at a valuation of 30p multiple, and Company B, which is growing at say 10 to 12% and say trading at 20p multiple. We would rather invest in Company A, which is growing at a faster rate, despite the fact that it is trading at a higher valuation than Company B, but growing at a slower rate. The objective being that we know within 2 to 3 years, Company A would actually start trading and start looking cheaper than Company B. And hence we believe this is the way we can actually end up making money. So when we are looking at different fund houses, there are different styles of investing. The broad perspective is either you look...
Before we go to that, you said 30 PE, 20 PE. So PE is, it's a ratio to say what is the valuation of a company,
absolutely.
Right?
There are various tools of measuring the value of a company. P ratio is one of them. You have enterprise value by EBITDA of the company. These are nuances that we look at.
Okay, so the higher ratio, higher is the valuation.
That's right. The more expensive it is. So that's the way we look at it. So if you're looking at a real estate, the higher the rate per square feet would mean that the more expensive it is. And that's the way we actually measure the company's valuation, whether they are large cap, mid cap, or any across the sectors. So it brings all uniformity when we measure the company in terms of valuations.
So you said that you would go buy that company even if the valuation is 30 PE over a company which is valuing at about 20 PE. So to what extent will you go? So do you go even if it's like 40 PE, 50 PE? What is the range, or do you buy whatever the valuations are?
So that's a very interesting question, and I've been advocating that whenever we are looking at valuation or a P multiple, you never look at a P multiple in isolation. You also have to see it in conjugation with the growth rate. You also have to see what are the return ratios, what is the cash flow. There are some more nuances when we look at investments. So one is in terms of what is the corporate profit. We need to also see what is the cash conversion. Is it just a book entry, or the company is actually able to generate free cash flow in the business? That means whatever profit that I'm declaring, is it being converted into actual cash which the company can spend, or it's stuck in various working capital, etc.
You said if the company is growing at about 40% of 40 PE, but say suppose if a company is growing at that rate, everybody wants to go buy that company because it's like growing at a very, very high growth rate. So in that case, the valuation of the company may also go up, right? In that case, what is the threshold that you put that after this I don't buy, but if it is below this, I would buy?
So there is no science behind. So whenever we are talking about investment, there are two parts of investment. One is the science part, where you're able to predict what are the earnings growth, what is the sustainability of the earnings, profitability, etc., what are the return ratio. The art part is what is the multiple that you should be giving to that company for that kind of a growth. This art part comes through sheer lot of experience through the various market cycles. Depending upon where we are in what phase of the market, that will determine the valuation that we have.
So that's subjective. Again, different fund managers may also have different views there.
Absolutely. It's the valuation, as I say, like beauty is in the eye of the beholder or the person who's evaluating the investment option.
Okay.
At any given point of time in the stock market, when somebody is buying, he believes that there's value in the company. At the same time, somebody is selling who believes that there's no value.
Got it. And that's why your style is called GARB, which is growth at reasonable valuation. So you see at companies which are growing, but at reasonable valuation. And that reasonable valuation will be determined by your experience in the investing world.
Absolutely. And we've seen many cycles, we've studied many sectors, and we know exactly how to react to each situation. I've always maintained that to be successful in the investment world, it is not just your ability to get the earnings right to the second decimal, but it's as important as getting the multiple right in terms of the valuation. And how well are you able to manage and react to a particular situation in the changing circumstances to determine whether that situation, that factor is relevant? Will it have an impact on the market? Will it have an impact on the company? Would actually determine what kind of a valuation you should be having. The P multiple is what determines and is also a function of what is the market mood. If the market mood is euphoric, the same company would be available at a much higher valuation. If the market mood is in the panic mode, the same company would be available at a lower multiple. The basic underlying fundamentals of the companies don't change. So we focus on the business and not on the stock price. The stock price is always an outcome.
Wow, there's so much. So if this is one style, what are the other styles that are there? And why did you choose this style only?
So we fundamentally believe that it's the companies which make money and not the markets. And equity market is nothing but an aggregation of all the companies. So the focus has to be always on the company's business per se. Now the question that you would ask is, why just GARB philosophy and why not look at value investing, where you tend to look at a cheap stock, etc. I think India is an emerging market where growth is what actually determines the return. And we've seen over a period of time, over multiple cycles, that people are willing to work with this strategy, and this strategy has worked in the last 25 to 30 years. Given where the demographic profile of the people are there, we continue to believe that economic growth is taken for granted, and that is a strategy which would work very well going forward.
Okay, what should I expect if I have to invest in Baroda BNP Paribas funds? Like, what is the kind of expectation? You said consistent returns. So is that what I can expect when I invest in funds of yours?
Sure. So there are a couple of things that you can expect from investment in Baroda BNP Paribas Asset Management or the mutual funds managed by us. The first one is true to label. When I say true to label, if you have investing in a mid-cap fund, you can be rest assured that the companies which will be forming part of the portfolio will all be mid-cap companies. Or if you're looking at a thematic fund, we will be true to the label. So what we say is what we do.
Everybody does that?
So there could be some variations out there because there can be some nuances in terms of what leeway the regulator allows and the interpretation of some of the underlying assets. So that's one part. The second part is the companies that form part of the portfolio, they will be very well researched out there, and there'll be a story, a fundamental story for each and every company that we have. We typically like to invest in companies where the business model are simple to understand, which we can model in to make a financial model, and the assumptions which can be validated independently. So what we are really looking at is a consistent growth compounder stories in a portfolio. That is only possible if we are able to identify companies which can sustain the earnings growth over a period of time. So in short, the return expectation that the investor can have is not only consistent but a risk-adjusted return which is aligned to the investor's expectation.
Got it. So whenever I want to know whether a fund manager has, what performance they've given, every time I have to see the benchmark return and see how the fund manager has given.
Absolutely. And I think that's a very important tool that we also use for measuring the performance of the fund manager. A benchmark return is one of the a measurement tool of the fund manager's performance. The other is how does he compare with the peers, all the other funds in the same class of funds that they are managing.
In your childhood, what did you want to become? You said you wanted to become fund manager?
I naturally gravitated towards engineering for my graduation because I'm come from a family of engineers. After I finished my management graduation, I joined management consultancy. But I quit within 2 years and I decided to become an analyst in one of the broking firms, tracking a particular sector. From there, I graduated to tracking multiple sectors. Then I became the head of research. From head of research, I became a fund manager. From fund manager, I became senior fund manager. And then the CIO looking after the entire investment strategy. So it's a journey which has evolved over a period of time. It was not really a planned thing because when I decided that I wanted to be in the stock market, I don't think this industry was the way it is right now. So as things have evolved, I've adapted myself and been aligned to what I like.
Then who did you look up to, in the investing side?
I think
when you started off in the career.
So there were a lot of role models. I mean, in terms of how you go about it, how you study a particular sector. There were a lot of people in the market, and a lot of them are really not known in terms of public this thing. They've taught me a lot how to look at industries, how to look at companies, how do you model out there. You read a lot in terms of what are the international guys doing, and that's an evolution which has taken place. So there's no particular role model. Depending upon my professional journey, the role models have changed.
Sanjay, as I see on the website, it says that you manage a couple of funds. So what are all these funds that you manage, and how do I decide which fund to go for?
Sure. So I manage 4 schemes at Baroda BNP Paribas Asset Management Company. They are the Baroda BNP Paribas Balance Advantage Fund, the Large and Mid Cap Fund, the Flexi Cap Fund, and the Focus Fund. So there are different strategies depending upon the investor appetite. For example, the Balance Advantage Fund is a fund which invests in equity and debt, and it's a very unique product where the investor does not have to decide what should be the asset allocation between the 2 asset classes. The fund manager automatically determines that based on a certain proprietary model. A flexi cap fund is a fund which invests across market capitalization depending upon the fund manager's view, whether to be invested in large cap, mid cap, and small cap.
It's spread across.
It is spread across depending upon the fund manager's view, and it takes away the decision making of the investor to decide where should be he or she be positioned when they're investing.
Okay, if I don't know where to invest, then I can choose a flexi cap.
That's the best way option in terms of not deciding in terms of the cap curve, whether to invest in small cap, mid cap, or large cap. The large and mid cap is a new category which the regulators define, where there's a minimum allocation of 35% to large cap and 35% to mid cap, and the balance can be decided by the fund manager. Unlike flexi cap, where the fund manager can be 0 to 100% in large cap, mid cap, or small cap, or a combination of any of the percentages. In large and mid cap, it's a defined minimum that has been determined for large and mid cap. The focus fund is a fund which is diversified, which is like a flexi cap. The restriction is the number of stocks that you can have in that fund. The number of stock has been restricted to about 25. Unlike a typical diversified portfolio, which will have anything between 45 to 55 stocks, in case of a focus fund, you have a concentration risk of the names, the number of stocks that you own in that.
So you said if I don't understand which one to pick, then I can go for flexi. So when should I go for focus?
So focus is when you want to take a concentrated risk. The risk that you're going to have is going to be much higher in a focus fund, because if you're having 25 stocks, even if 2 stocks don't work, the return impact can be significant compared to a flexi cap. So once your risk appetite increases, that's when you need to look at a focus fund. But if you want a steady return, then you should be happy with a flexi cap approach.
You said you're looking at this, like, of course, the universe is much large. There are 4,000 companies, and then you select only 1,000 companies, and then finally you decide to put only 45 to 50 stocks in a fund. But how do they go about looking at so many companies?
Sure. So just to put in perspective, there are about 4,000 plus companies listed on the Bombay Stock Exchange. Based on our addressable market cap universe of 5,000 crore plus at this juncture, there are about 1,000 plus companies, of which we have about 500 companies in our investment universe. We have a team of sector specialists, analysts, who track a particular sector. Their job is to look at what is actually happening in the sector and all the companies within the sector and how are they performing and what is the view out there. They'll have a financial model and a valuation model to arrive at the fair price. So that's the job of the team out there. Then you have fund managers. Again, while we have sector specialists for the analysts, what we've divided the fund manager role is into 3 parts. The way a large cap fund manager would think is different from the way a mid and a small cap fund manager would think. So we've classified the fund managers also depending upon their own investment style and given them assets which are predominantly large cap, and to the mid and the small cap which are predominantly mid and the small cap. In between you have a category which is called the flexi cap or a multi-cap, and all the schemes which are diversified schemes. So we have a team of analysts out there, a team of fund managers who take care of all the 3 different strategies. What is interesting is the job definition of each one is defined and is well understood. The analyst's job is to study all the companies, build up an investment case, and present it to the fund manager. It's the fund manager's job, depending upon what investment strategy they are running, to pick and choose the company that they want to have in the portfolio. The primary responsibility of the fund manager is to manage the risk in the portfolio. So it's all well defined in terms of who's doing what out there.
As a CIO, what do you do? Oversee everything?
So I have 2 roles out there. As a CIO, yes, my entire objective is to oversee the entire investment process, adherence to and set the direction for the investments, and monitor the performance of everybody out there.
So everybody else also follow the same GARB formula that you've said?
So again, we actually encourage diversity of opinions, because no single strategy is going to work at all times of all periods of time. We actually encourage all the people to voice their opinion and give a view on each and every aspect which is discussed. So there's a diversity in terms of their education, there's a diversity in terms of the way they approach towards investing, but by and large I would say they all follow a similar strategy.
How long have you been with this company, Sanjay?
Yes, so I've spent about 12 years with Baroda BNP Paribas Asset Management Company.
Okay, so earlier also you were following the same style of GARB?
Yes, I mean this is a time tested which I've learned over a period of time. We've incorporated few basic changes. We focus a lot more on the cash flows or some profitability measure when we are looking at valuation. So it's a process which has evolved over a period of time based on our learnings and the lessons that the market has taught us.
If there is one thing I learned about mutual funds, they say don't immediately look at past returns, try to understand the fund manager. So I think I've understood that part of understanding your style and investment philosophy. Now looking at the returns, you talked about benchmark returns, and if you see for some of the funds, while it is good in the short term, in the long run it hasn't slightly shied away from meeting the benchmark return. Why is that so, Sanjay?
So it's to understand the underperformance or not so good performance in the long term, you need to understand the evolution of this company. Almost 3 years back, there were two AMCs which merged together, Baroda Mutual Fund as well as BNP Paribas Asset Management Company.
Okay.
They came together to form what is today called the Baroda BNP Asset Management Company. So there were two distinct funds which were in existence prior to the merger. Post the merger, we've seen a significant improvement in the performance. So the team structures have changed, the fund managers have changed, the processes have been incorporated because you had two different teams at that point. We have a single team now working together.
Okay.
And that is the key difference. So when you're looking at a long-term performance, it may not be a like-to-like performance that you're benchmarking. Well, that's the reality. That's the way the regulator wants us to put the performance. But I'm not sure whether that's the right way that the investor should look at it. Over a period of time, we've been communicating to all our channel partners and investors why we should be looking at the performance in the last 2.5, 3 years after the merger, rather than just focusing on the very long-term performance.
If I want to understand that bit more, so you're saying that earlier there were two funds, now that has been merged. That's why the long-term performance has been not so good. After the merger, the performance have started improving, and in the short run, the performance has been good, but not in the long run. But what if I had invested in one of the Baroda PNB funds? How would my return be?
Sure.
Would it have actually beaten the benchmark?
Sure. So let me just explain. Supposing you had invested in the Baroda mid-cap fund.
Okay.
And you had not invested in the BNP Paribas mid-cap fund. The return that you would have experienced when you were at Baroda would continue to that extent. 4 years, 3.5 years, 3 years back, both the schemes merged together.
Which schemes?
The Baroda mid-cap fund merged with the BNP Paribas mid-cap fund. So what you're seeing right now is the merged performance of a single fund manager. So you would have had a different fund manager for mid-cap in Baroda mid-cap,
Right, yeah.
and a BNP Paribas mid-cap, there would be a different fund manager. There's a possibility that there could be a third fund manager managing the fund right now. While there are certain schemes where the same performance continues because it's the same fund manager and the other AMC did not have a fund of the same category. For example, if you look at a BNP Paribas consumption fund, Baroda did not have such a scheme. So therefore, the performance that you see is of the same fund and of the similar fund manager, and it's been fairly consistent. It is only where there have been merger of the two schemes that we are facing some challenge in terms of the past performance. So if I look at the performance in the last 3 years, it is well up to the mark. We are consistently beating the benchmark out there. If you're looking at performance beyond that, it may be a challenge depending upon which AMC's fund you're looking at and you had invested.
It happens with all the mergers in the similar way, where whenever there is a merger of mutual funds.
So, you'll be surprised to learn that this is a unique experiment in the mutual fund industry. Historically, you've always had a takeover of a fund, where one AMC takes over another AMC. Okay, you're actually adding the assets. This is a unique experiment where both the shareholders have come together to have a virtually equal stake in the AMC. Baroda is also there. Baroda had 100% of Baroda Asset Management Company. BNP had 100%. They both come together to have almost equal stake in the new AMC.
Got it.
And this is a unique thing, which is a unique experiment because neither of the individual guys had a scale to operate in. On a 1+1 basis, we are trying to show that it is more than 2. Because you're combining both the assets out there, and we've actually shown how it is possible. So if you look at classifying just the investment performance, what was an individual AMC, the combined AMC has been able to deliver much superior returns.
If I'm a new investor, does this merger concern me in any way?
So what we are bringing to the table out here are two strong parents. Bank of Baroda, which has got a history of over 100 years in the country. BNP, which has got a history of over 100 plus years in Europe. There's a certain process which has been defined by both the shareholders. They give strategic vision to the company out there. While the day-to-day business is being managed very effectively by professionals. For example, I'm not a part of the Bank of Baroda or BNP system. So is my CEO and the head of sales, etc. What the investor can expect is a consistency in performance, a process which is being overlooked by people who understand the processes for Bank of Baroda, risk being managed by BNP, who actually specialize out there. So their commitment to the business is very high out there.
So usually they say when two friends start a business, there would be some conflicts in the long run. So now, because there are two entities that are running a similar fund, is there any scope for any conflicts, or how do you manage if there are any conflicts?
So I don't think that you will have conflict per se, as long as your objectives are the same. I think what both the shareholders keep debating is in terms of the pace of growth that we should be having. And I think there's a fair degree of alignment in terms of the expectation, in terms of where we are headed and how fast we are headed. And they're driving the entire initiative.
Great. So how do you invest, Sanjay? You all invest in equity, mutual funds, or do you also invest in stock?
As a policy, first of all, 20% of my salary goes into my own funds, which is called the skin in the game, which means that I eat in the same hotel where I run the restaurant. Yeah, so it's not that I don't believe in my own schemes. I'm essentially a mutual fund investor. I really don't look at stocks, etc. Whatever investments I had made in my initial phases, I continue to own them. There's been no transaction for the past more than 12, 13 years. I'm a mutual fund investor because I do firmly believe that that's the best way of diversification, where you're giving your money to an expert to manage, where you don't have to worry about the daily volatility, and the returns have been very good.
What do you do when you don't think about stocks, finance, investing?
Oh, so there's very little beyond that. I'm actually an orchard farmer. So I actually go about spending time at my farm. I'm nurturing some.
Where is it?
So this is about 100 kilometers from Mumbai. I've spent almost now 7-8 years, and I've seen the fruits, and there's a lot of similarity between farming and investing.
A weekend farmer.
I would tend to believe that, yes, a weekend farmer, but so there's a larger objective out there. What I find is the Indian farmer does not have the wherewithal or knowledge to make a difference in terms of the productivity gains that they can have from farming. Initially, I had a lot of challenge because I was a city slicker going to the village. So I'm trying to set up a role model of a farm which the villagers can copy and templatize and replicate the whole thing. The entire objective being to ensure that there's productivity gain and there's an upliftment of people around the village.
Now, coming out of the shoes of your daughter's friend and being a person from Zerodha Varsity, what is your way of giving back to the society?
I'm a very private person and I would hate to discuss it, but since you've asked about it, there are a couple of things that I do giving back to the society. One is, of course, in the financial means. So I've adopted a family where a single parent is there. So I've paid for their education. I've seen the children grow from 12th grade and they become lawyers. And so I've taken care of them. Over and above this, I've actually sponsored 3 children every year from an education through a charitable organization called Light of Light Trust. They actually focus on the rural side, on the underprivileged children. And it's really heartening to see how they have evolved over a period of time. So I've seen from what the person I was sponsoring 8 years back and how they've come into the social fabric of life, the way their confidence is built up and the way they're contributing to the society. It is really amazing and it's very touching.
That's brilliant. That's all for now, Sanjay. Thank you so much for joining us. It's been a pleasure talking to you.
Thank you so much for having me. It's a pleasure talking to you.